This is Nightly Business Report with Sue Herrera and Bill Griffin.
Know your ABCs. Google's parent Alphabet reports strong revenue growth, but costs rise, and that's raising some questions.
Beyond stocks, not convinced that the market's bounce will hold? Maybe it's time to consider alternative investments.
Cashing out. A new startup will buy your home so you can rent it back. And a growing number of people are doing it. Those stories and more tonight on Nightly Business Report for Monday, February the 4th.
Good evening, everyone, and welcome. Alphabet is a Silicon Valley heavyweight, and tonight it reported better than expected earnings. At first glance, the results are somewhat of a relief given the decline in the stock price late last year. Sales rose despite mounting public pressure over issues like privacy, and the company authorized an additional $12.5 billion in share buybacks. But costs rose as well, and that is not sitting well with investors. Here are the numbers. Alphabet earned $12.70 a share, easily topping expectations. Revenue was up more than 20% from a year ago to $39 billion. But those cost concerns sent the stock lower in initial after-hours trading. Josh Lipton has more.
$27 billion. That was a big number in Alphabet's latest earnings report. It refers to revenue from Google properties, the core properties that this company owns and operates, like Search and YouTube. Aaron Kessler of Raymond James says that beat his estimate, growing at 21.5%. On the other hand, though, Kessler did note some disappointing metrics, too, that gross margins, he said, were lower than expected, and R&D expenses were up $800 million, higher than what he was looking for. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Daniel Flax joins us now to talk about these numbers and his take on the stock. He is senior research analyst at Neuberger Berman. Dan, good to see you. Thanks for joining us tonight.
Great to see you both.
Any red flags for you, these expenses or anything else?
Bill, I think overall the business appears to be healthy. The core search business was on target. YouTube is seeing strong growth. The Google Cloud business appears to be doing very well. What people are a little bit disappointed by is, of course, the margins and obviously the level of expenditure in some of the other bets. But I think if we step back and think about what's going on with this company, this is really a longer-term focused company that is putting money into newer areas like Waymo, for example, with autonomous driving. So overall, we think it was a solid report. We understand some of the concerns, but I think the business remains on track.
You like the stock for the next 1 to 2 years. Do you have a specific price target on the stock?
We can't speak to specific price targets, but what I would say is that I think if you look at some of the key secular trends around the cloud and mobile and digital, and this really speaks to the transformation of industries and businesses well beyond technology, and Google is really sitting in the middle or at the center of a lot of those trends and empowering others, and that is what ultimately we think drives the attractive top-line growth story and what we think can create additional shareholder value over the next couple of years.
You know, I think about there's been so much skepticism about Google over the years, going back to its days of the IPO. People thought it was too expensive, but you made an interesting point in your most recent research report that we are still making a transition to a digital age, and they're part of that transition, right?
I think that's right, Bill. And when we speak to customers, when we speak to people in industry, all of them are really trying to transition their own businesses towards an age where they have to interact with their customers, their partners, everybody in a very different way. And they need a company like Google, like Alphabet, to help them do that. And the key for Alphabet is to continue to innovate, to invest. Not everything they do is going to work, and it's not always going to work in the timeline that Wall Street would like. But the feedback and really the takeaways from our research suggest that the longer-term initiatives underway at the company are really in line with what customers are looking to do. And that, we think, is ultimately critical to creating shareholder value.
Daniel Flax with Neuberger Berman, thanks again for joining us tonight.
Thank you.
On Wall Street, tech stocks helped lead the market higher as additional profit reports trickled in to start the week. The Dow Jones Industrial Average rose 175 points to 25,239. The Nasdaq added 83, and the S&P 500 was up 18.
Well, Wall Street will be watching President Trump's State of the Union address very carefully tomorrow. He's expected to discuss trade priorities and specifically the need to pass his new NAFTA, now called the U.S.-Mexico-Canada Trade Agreement. Kayla Tausche is in Washington for us tonight.
The U.S.-Mexico-Canada trade agreement was signed in November, but it's now staring down a months-long debate on Capitol Hill, where Republicans have bristled at its wage requirements and Democrats feel it doesn't go far enough to protect manufacturing jobs. The agreement that was supposed to have something for everyone has ended up alienating both sides. Lori Wallach is director of Public Citizens Global Trade Watch, a liberal group.
They didn't quite finish the job on the environment and labor standards, and unless those get strengthened, jobs will continue to be sent out to Mexico to chase $1.50 an hour wages.
Gabriella Beaumont-Smith is with the conservative Heritage Group.
Labor provisions and environmental regulations, it's not their place to be in a trade agreement. It's supposed to be about trade.
And then there's the steel and aluminum tariffs that the U.S. still charges its North American neighbors. Prominent Republicans have said they won't vote on it until those are gone. Auto tariffs could complicate the situation, as could a report from the International Trade Commission on the economic impact of the deal. That was delayed because of the government shutdown and could be pushed back until April, making the path forward cloudy. For Nightly Business Report, I'm Kayla Tausche in Washington.
The U.S. is also trying to settle a trade war with China. And now that country is celebrating the Lunar New Year, which could show just how much of an impact the tariffs are having on its economy. Eunice Yoon is in Beijing.
It isn't clear just how much work is going to get done on trade this week. The Chinese government is officially closed for the Lunar New Year holiday, and the timing isn't particularly convenient given President Trump's March 1st deadline only a few weeks away, though some officials tell me they are working at least part of the time. A tremendous amount of work still needs to be done. Trade Representative Bob Lighthizer and Treasury Secretary Stephen Mnuchin are expected to come to Beijing for another round of talks. The two sides might have to work out the logistics of another Trump-Xi summit, and negotiators still need to handle many contentious issues like forced technology transfers. Because of the holiday, the leadership here will be able to get another read on the economy. The Lunar New Year is China's equivalent to Christmas or Thanksgiving. People go home for big family events and buy a lot of gifts. 400 million people are traveling this year. Economists use this sales period to gauge the Chinese consumer. So this holiday, economists are looking at luxury goods, duty-free items, casinos, jewelry, as well as alcohol. Over the weekend, President Xi gave his Lunar New Year speech, hailing the economy's, quote, steady progress. And the Lunar New Year sales will give a better picture of the health of the Chinese consumer, and that could put more pressure on the Chinese government as the deadline approaches. For Nightly Business Reports, I'm Eunice Yoon in Beijing.
Meanwhile, the government played catch-up today, releasing a group of economic reports that had been delayed by the partial government shutdown. And for the most part, they pointed to a slowing economy toward the end of last year. In one of those reports, factory orders in the U.S. fell more sharply than expected. That was in November. In another report, a key measure of business investment also fell. But there was a bright spot. A separate report showed that orders for durable goods rose slightly in November from the prior month.
Oil prices today touched a 2019 high, but then they pulled back a bit. Prices rose initially on OPEC-led supply cuts and U.S. sanctions against Venezuela's petroleum industry. But that factory orders report that we just told you about sparked concerns about a possible slowdown in economic demand, and that sent domestic crude lower to about $54 a barrel. And the shifting prices in the oil market and the sharp bounce back in U.S. equities have probably left you a bit weary and wondering what is next for the market and if there are any alternative investment options you should be considering. John Nigerian is the founder of the Nigerian Family Office, and he joins us now to discuss. Perfect timing.
Welcome aboard.
Thank you, Bill. Thank you, Sue.
And one of the things you're looking at is the gold market, but a specific play in gold.
Yeah, specifically gold coins. Why not own it directly if you want an alternative to the stock market? And this is an alternative, Bill, that has returned over the past 15 years about 315% versus 58% for the stock market. So you could pretty much say 5 times what the stock market return would have been.
But you're talking gold coins here.
Gold coins, yes.
And how much should you pay for those gold coins?
Well, that is one of the keys. You want to find a dealer who will sell you with as small a premium as possible. Most of them that I looked at that had good business ratings were between 3 and 4%. Certainly under 5% is what you should expect to pay. So with gold at roughly 313 a share,
right,
or an ounce rather, a 1 ounce coin shouldn't cost you more than about $1,360.
Now, when we asked you for alternative investments, you caught us off guard with the next one here.
Right.
The Lending Club.
Yeah, Lending Club.
Peer-to-peer loans that you can, you put money into this fund and then they loan it on your behalf.
Exactly, and you get to pick the people or the businesses that you're lending to. So that's one of the things I liked about it. Number two, you get diversification. You're not saying I'm putting all of this on John Najarian. You could say I'm putting $25, that's their minimum, $25. I could put 50, I could put 500, but you're being the bank. You're Warren Buffett here. You're lending the money out and you're getting that interest rate. The borrowers come because they're getting a lower rate than they'd pay the bank because the bank might charge them 18%.
Right.
Maybe you're getting 11 or 12%. And you're spreading that risk around with a bunch of different businesses or individuals. And the returns have been pretty darn good, especially since they track all of this for you, Bill.
The third one I was curious about. Pay off your bills. That seems like a no-brainer,
Sure.
right? Or borrow from yourself.
Yep.
Borrow from your 401k or
Exactly.
your IRA. Sharon Epperson is having a fit right now.
Yes, I know. She's spinning right now.
Well, and the reason you borrow from yourself is the IRS sets a minimum that you must pay yourself back, the interest rate that you charge yourself. If you don't pay it back, of course, you could have penalties as well as the interest charges. But assuming that you're a consumer that's going to be paying yourself back and paying yourself instead of the bank, I think makes so much sense because let's say you're paying off a loan at 8% or 10%. Instead, you could be here paying yourself 6 or whatever the IRS says is the minimum that you can charge. And it makes all the sense in the world. You're borrowing from yourself.
We'll get you together with Sharon for lunch sometime.
Okay.
You guys can talk about that.
Thank you.
I want to be a fly on the wall. John, thank you very much. John
Love
Najarian
Sharon.
with the Najarian Family Office. We all do.
Time to take a look now at some of today's upgrades and downgrades. We begin with ConocoPhillips, which was upgraded to buy from neutral at Goldman Sachs. The analyst says that the company's long-term growth opportunities, including Alaska, Australia, and Qatar, are underappreciated right now. The price target now $82. The stock rose more than 1.5% today to $69.93. Goldman Sachs rates Match Group a sell in new coverage. The analyst says that the stock's valuation is high relative to its growth prospects. Price target so now is $45 and shares fell a fraction to $54.43. Meanwhile, Intuit was upgraded to equal weight from underweight at Morgan Stanley. The analyst says that new products will help that company to exceed conservative revenue expectations. Price target $225 and shares rose 3% today to $220.91.
Still ahead, the big rig indicator.
New orders of big rigs like these are often seen as an economic indicator, but industry experts say the latest numbers, they may be misleading. I'm Frank Holland in Toledo, Ohio. That story coming up on Nightly Business Report.
Every night we bring you a lot of facts and figures on the economy, but sometimes all you have to do is look at the number of trucks on the road because demand for big rigs can be an indicator of economic strength. Frank Holland is in Toledo, Ohio.
Orders of new big rigs like these are often seen as a rolling economic indicator.
Historically, Class 8 new truck orders are a bellwether of the state of the economy.
Technically called Class 8 trucks or simply tractors, these trucks pull trailers worth of goods all around the country, delivering what we buy to the stores that we buy them from. Steve Bassett, a truck dealer in Toledo, Ohio, says 2019 is off to a good start.
On the dealership floor level, we are seeing strong demand. In fact, I know I just took down a very significant order just 3 days ago.
But something peculiar is happening. A recent report shows a 3-month decline in new truck orders, something you would not expect given the demand. Historically, it's data that could drive up concerns. An economic slowdown is just down the road.
It's hard to add water to a full glass.
But Kenny Veith of ACT Research says new truck orders are downshifting primarily because they reached a record 490,000 last year, and there is still a 300,000 order backlog now.
That unbuilt level of backlog is about twice what the average backlog to build ratio is.
That means at least a 9-month wait for new trucks. Veith says there may be a lot of demand, but little incentive for manufacturers to increase capacity.
The industry is reasonably at capacity right now in a 2-shift setup. If you push to 3 shifts, you don't get that many more trucks.
I think there's a great demand for tractors.
Monica Southward, the owner of First Express, a transportation business, says, at least right now, she's focusing on another challenge.
So we are busy and we do need the trucks. The biggest challenge is the drivers.
A shortage of 60,000 truck drivers is forecasted for 2019.
Isn't it cool? This is very cool. You can get used to it.
Uncertainty about getting real drivers behind the wheel, an uphill climb for an industry facing record demand. For Nightly Business Report, Frank Holland in Toledo, Ohio.
Conflicting reports on an activist investor and a major drug maker, and that's where we begin tonight's market focus. Bloomberg News reported that Starboard Value had taken a stake in Bristol Myers Squibb. That sent the stock higher in early trade today. But then a report from CNBC's David Faber said that Starboard had not yet contacted Bristol's management, and that sent the stock in the other direction. But it still closed higher by nearly 2% today to $50.85. Elsewhere, Starboard did strike a deal with embattled pizza chain Papa John's. Starboard will reportedly invest $200 million, which will reduce founder John Schnatter's stake in the company to around 26%. And Starboard CEO Jeff Smith will become chairman of the board of Papa John's. Shares of the company rose almost 9% today to $41.97. And Spotify is reportedly in talks to buy podcasting company Gimlet Media for about $200 million. That move would diversify Spotify beyond music streaming and mark the first time it has purchased a content company. Shares of Spotify rose 1% today to $138.60.
Tesla is acquiring battery technology company Maxwell Technologies for a little more than $200 million. Maxwell makes devices that store and rapidly deliver surges of energy. Tesla's CEO, Elon Musk, is said to be a fan of the technology's potential for speeding up electric car charging. Tesla rose a fraction to $312.89. Maxwell Tech, which is a small cap stock, soared 49% to $4.59. Newspaper giant Gannett has rejected a hostile takeover bid from Digital First Media. Gannett's board of directors questioned the proposal's credibility and said the offer undervalues the company. Digital First Media, a hedge fund-backed company officially known as MNG Enterprises, offered in January to buy Gannett for $12 a share in cash. The stock fell 2% to $10.97. Cisco reported better than expected earnings despite rising supply chain costs. The food service distributor plans to lay off 10% of its workforce and automate some jobs in an effort to bring down expenses. The company's quarterly revenue came in slightly below estimates, but shares rose more than 4.5% to $66.64.
Goldman Sachs may claw back executive pay over the Malaysian corruption scandal. The bank's board has approved now a provision that could see former CEO Lloyd Blankfein and other senior executives lose out on millions of dollars in compensation, depending on the outcome of the investigation. Last year, the Justice Department launched a probe into the Malaysian fund, where $4.5 billion was allegedly diverted to the personal accounts of various government officials. That investigation is still ongoing, and Goldman Sachs arranged and underwrote bonds for that fund. And the Malaysian government has accused Goldman of enriching itself at the expense of the Malaysian public.
The banking industry is watching what's happening in Washington, especially with the new makeup of the powerful House Financial Services Committee. The panel is led by Congresswoman Maxine Waters, who is known for her fiery rhetoric towards Wall Street. But in a recent interview with John Harwood, she took on a more moderate tone.
At one point during the campaign, you said about bankers.
What I'm going to do to you is fair. I'm going to do to you what you did to us.
So you recently met with Jamie Dimon of JP Morgan, David Solomon of Goldman Sachs. What did you do to them?
Well, first of all, let me just say this. When you are speaking and you're among friends and you're with an organization that you have great relationships with, you take the opportunity to have a little fun, to perhaps describe to them in ways maybe you wouldn't describe to other people how are you going to do things, and you get them basically involved in understanding what you care about and what you have learned from your time in office, and you make these kind of quips.
So people shouldn't take that literally.
Not literally, yes, absolutely. I have an open door. I welcome everybody, from bankers to activists, nonprofits, the veterans, people involved in the health industry. Even if you know you disagree with a particular industry, you let them in and you let them talk to you.
Are there particular issues where you think there's a very good chance that you'll be able to work with those financial institutions?
Well, I think the work that I have done already as a ranking member of the Financial Services Committee demonstrates that I'm a strong legislator and I know how to work with the opposite side of the aisle. I know when to work with the opposite side of the aisle.
What role in your philosophy does redistribution of income take?
I'm not defined in that way, that I believe in redistribution, because that implies that you want to take from the rich and give to the poor. I'm defined about fairness. I'm defined in a way that would create equal opportunity.
Congresswoman Walters said her goal with Wall Street executives is persuasion, not legislation.
Coming up, revolutionizing real estate. One startup wants to buy your home so you can rent it back. The one-time bond king is retiring. Bill Gross has announced he's planning to step aside after more than 4 decades in the world of finance. Gross co-founded PIMCO back in 1971. He was named the Fixed Income Manager of the Decade from 2000 to 2009 by Morningstar. When he left PIMCO in 2014, the firm was the world's largest bond firm with nearly $2 trillion in assets. But his departure from PIMCO was messy. There were personality and culture clashes with management. So he went to Janus Henderson Funds, where he did not have the same level of success. And now he's leaving to focus on his charitable foundation.
The retailer Charlotte Russe has filed for bankruptcy. The women's apparel company plans to close about 94 stores. During court proceedings, it will continue to operate its website and keep open some stores. It had 400 stores across the U.S. Charlotte Russe is privately held and backed by a private equity firm.
Today's homeowners are sitting on a record amount of equity, but a lot of them cannot access it, sometimes because they don't have high enough credit scores to qualify for refinancing. But now a new company is offering a way for them to tap that equity without moving a muscle. Diana Olick explains.
Chris Driscoll needed cash to invest in his real estate business. And while he had plenty of equity in his Gainesville, Georgia home, he couldn't access it.
If my credit score was a few more points, or, I made the banker happy that day, or whatever, I could have probably done it for a little less money. But that's not how the world works.
Enter EasyKnock, a barely 2-year-old company that will buy your home from you but let you stay on as a renter. At any time during the lease, you can buy your home back.
EasyKnock's a company that's allowing people to access equity in their home that have been shut out by the traditional lending markets.
So I'm moving in as you're engaged.
EasyKnock makes money through monthly rent and extra fees. At the end of the lease, which can be up to 5 years, the tenant has the right to choose between buying the home back or selling it to someone else. EasyKnock does not want to keep it.
We are not in the business of continuing to own homes.
So far, the company has bought about 100 homes in 5 southern states, but with a recent infusion of $100 million from investors, Kessler said he expects to expand to 36 states and 2,000 homes this year alone. For Chris Driscoll, the financial process was pretty easy, but he admits there is an emotional downside, especially if he's unable to buy it back at the end of his lease.
But there are benefits as a renter, too, like not paying property taxes, homeowner's insurance, or any of the maintenance on the home. For now, EasyKnock is contracting out its rental management business, but as it expands, expects to bring that in-house as well. For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about this new way to tap into your home equity, you can head to our website at nbr.com.
And finally tonight, one of Wall Street's favorite and least scientific traditions, the Super Bowl indicator. It says the market will rise during the year after a team from the original NFL wins the big game, and it will fall when a team from the old American Football League wins. That means with the Patriots' victory last night, stocks should fall this year. But as you know, the Philadelphia Eagles, an original NFL team, won Super Bowl 52 last year, and stocks dropped. And the year before that, when the Patriots won, stocks soared. So maybe the Super Bowl indicator isn't so super anymore. We'll see.
If it ever was. Before we go, a look at the final day on Wall Street, the day after the Patriots win, and the stocks went up 175 points. So we're at 25,239. The NASDAQ added 83 points today, and the S&P was up 18. We were at the highs of the session. And more earnings are still to come this week.
That's right. It's going to be a busy week.
Yes.
So thank you for joining us. I'm Sue Herrera. Thanks for watching.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.